If you're watching this right now, you already know many stocks are in a crash. Stocks are down, fear is high, headlines are negative, and most investors are either frozen or selling at the worst possible time. But historically, crashes have created some of the greatest wealth-building opportunities of all time. And today, I want to talk about 3 stocks that our AI-driven investment models are flagging as high conviction opportunities during this current sell-off: Adobe, Salesforce, and ServiceNow. Before we dive in, let me be clear. These are not random picks. These selections are supported by AI models that analyze valuation compression, earnings durability, recurring revenue strength, long-term growth rates, free cash flow trends, and historical recovery patterns during previous downturns. When high-quality companies in strong industries fall significantly below their historical valuation ranges, our models begin identifying them as potential long-term accumulation zones. And here's what's interesting. All 3 of these companies operate in the SaaS industry. Software as a service is one of the most powerful business models ever created. Recurring revenue, high margins, sticky customers, massive scalability, and historically SaaS has been one of the strongest performing sectors coming out of economic downturns. What we're seeing right now is a broad market sell-off, pulling down even dominant SaaS leaders, and that's where historical opportunity forms. Let's start with Adobe. Adobe is the backbone of the creative and digital marketing economy. Photoshop, Illustrator, Premiere Pro, Acrobat. These are industry standard tools embedded into workflows globally. Our AI models highlight Adobe because of its strong recurring subscription revenue, high operating margins, durable cash flow generation, and long-term pricing power. Even during economic slowdowns, creative and digital marketing functions don't disappear, they evolve. Adobe's integration of AI tools directly into its creative suite also strengthens its competitive moat. When valuation multiples compress during a crash but revenue durability remains intact, AI models tend to view that as mispricing driven by sentiment rather than fundamentals. Next is Salesforce. Salesforce is the global leader in CRM, customer relationship management software. Businesses rely on Salesforce to manage sales pipelines, marketing automation, customer service operations, and revenue tracking. These systems are mission critical. Our AI analysis favors Salesforce right now because of its recurring revenue model, strong enterprise retention rates, expanding margins, and AI monetization through its Einstein platform. The models also factor in historical recovery data. During previous downturns, high-quality SaaS companies that maintained revenue growth while valuations compressed often outperformed significantly in the following cycles. Salesforce currently fits that pattern. Third is ServiceNow. ServiceNow provides enterprise workflow automation across IT, HR, operations, and digital transformation initiatives. In uncertain economic environments, companies look to reduce inefficiencies and automate processes, which directly supports ServiceNow's value proposition. Our AI models flag ServiceNow due to its expanding total addressable market, high contract renewal rates, strong subscription revenue base, and consistent enterprise demand. Again, valuation compression combined with durable revenue growth creates the type of setup quantitative systems identify as long-term asymmetric opportunity. Now let's zoom out. All 3 of these stocks share 3 powerful characteristics. 1, they operate within the SaaS industry. 2, they generate recurring subscription revenue. 3, they maintain strong competitive moats with high switching costs. SaaS has transformed global business over the last 2 decades. It replaced one-time software sales with subscription ecosystems that generate predictable cash flows and scalable growth. That structural shift hasn't reversed. If anything, it's accelerating due to AI integration, cloud adoption, and enterprise digitization. This is why I call this a historical opportunity. Market crashes reset valuations. They create temporary disconnects between price and long-term business performance. AI models don't react emotionally. They analyze patterns, revenue durability, margin stability, valuation percentiles, recovery timelines. And right now, those models are indicating that high-quality SaaS leaders like Adobe, Salesforce, and ServiceNow are trading at levels historically associated with strong forward returns over multi-year horizons. Now, this is not about timing the exact bottom. No model, human or AI, can predict short-term price fluctuations perfectly. This is about probability and long-term positioning, strategic accumulation, phased entries, thinking in 3 to 5 year windows instead of 3 to 5 week windows. Risk management still matters. Never invest money you can't afford to hold for years. Diversify across sectors. Avoid overconcentration. But if you believe in the continued growth of SaaS, enterprise automation, AI integration, and digital infrastructure, then this crash may represent one of the most attractive entry points we've seen in years for dominant industry leaders. When markets are euphoric, everyone wants in. When markets are fearful, opportunities quietly build. According to data-driven AI analysis, Adobe, Salesforce, and ServiceNow are three SaaS giants currently positioned at valuation levels that historically have rewarded long-term investors. This is how wealth is built, not by chasing hype at all-time highs, but by buying elite businesses when sentiment is low and holding through the cycle. If you found value in this AI-backed breakdown, make sure you like this video and subscribe for more data-driven investing insights. And drop a comment below. Which of these SaaS leaders do you think has the biggest upside over the next 5 years?